I want to get your take on some of these earnings. So Tesla's kind of understandable. They did miss on profit, even though everybody says it's a AI robotics company. Missing on profit's important. But when you look at IBM, that's an example of a company that beat expectations, raises guidance, and is trading lower. What is that saying about investor sentiment in this market?
Yeah, I think it's part of the market sentiment overall. I think markets are a little bit concerned near term. There's sort of this perspective that you have high valuations, which are pricing in perfection. For the forward PE ratio on the S&P is 23 times. You've got the tech bubble was at 25. You've got significant market concentration. You've got this possible bubble in AI capital spending. Are we spending too much money on data centers? And you've got market breadth slowing down. So you take all these together, markets are a little jittery. So these earnings that are coming out, they're beating expectations, but at the same time, there's what's next. Show me the money. What's coming on next? What's the future? And there's a little uncertainty overhanging stocks near term.
All right. So right now you're saying that any dip is viable right now, but also you're raising some questions about the AI trade and also the concentration in the market with some of the biggest stocks making up about a third of the S&P. If you're concerned about the path forward, then why is every dip viable?
Sure. I think so near term, we do think there's a lot of risk in the market. It's rare to have a 38% rally off of a low, and that's the biggest rally in over 50 years, given the April 8th sell-off. But we do believe that a pullback in the market is likely, maybe a 3%, maybe a 5% correction. But we continue to point to a lot of good reasons going forward to buy the dip. First of all, we just don't see a bear market. You need a recession. The economy is a lot stronger than the labor market suggests. Second of all, we've got tariffs adding about $350 billion run rate. Third of all, I think this is so important. Next year, 2026, is a year of stimulus. You've got both fiscal stimulus and monetary stimulus. And of course, earnings growth next year looks stunning. Large caps up about 13.3%, small caps up 22% year over year. And you got a lot of cash on the sideline ready to get in at better valuations. As we've been saying for the last 3 years, any pullback is a buy the dip opportunity.
All right. Also, you see the dollar strengthening from here. If you look at the last month, the dollar's up over 1.5%. If you see a strengthening going into next year, doesn't that impact some of your thoughts about next year? Because a weaker dollar has really helped earnings and earnings outperform.
Yeah, I think that's part of the reason why we are a little bit pivoting away from non-U.S. Yeah, we do have international in our portfolios today, which has benefited from a weaker dollar, especially with currency translation. We do see that a lot reversing a bit. We do believe the dollar is going to rally. There's no way the dollar should be at a 3-year low right now. Think about this. Over the last 12 months, we've had record net capital inflows. These are foreigners buying our treasuries. That's dollar positive. We're exporting a ton of oil. We're producing a ton of commodities. You need the dollar. We do see the dollar rallying, and we do says at the end of the day, that's going to put some pressure on international investing.
All right. One other area you like right now, it's healthcare here in the U.S. We were just talking about the biggest laggard on the S&P. It's Molina Health. One of the issues there is their marketplace business under quite a bit of pressure. Came up very short on earnings. We're seeing a lot of pressure on healthcare from a lot of different angles. Why do you think right now is the time to get into healthcare?
Yeah, first of all, we just upgraded the healthcare sector just recently, and we do believe there's a lot of cautious investor sentiment. It makes sense. You've got regulatory uncertainty, drug pricing reforms, but valuations are so extremely attractive. And keep in mind, I'm aging, you're aging, we're all aging every single day. Long-term great tailwinds driven by demographics, managed care demand, and just, of course, biotech innovation. This is supporting the sector. We like the sector, especially at this cheap valuation right now.